Imagine pulling off the biggest tech debut in American history on a Friday, and then watching your home market literally implode on Monday. Wall Street is popping champagne over a massive memory chip maker's listing, while the trading floor in Seoul is in complete freefall. This wasn't just a bad day for tech, it was a multi-billion-dollar financial trap, and we're about to dissect exactly how it was sprung.
We're talking $2.6 billion. That's the size of the real-time gamble everyday retail investors made, stepping directly into the path of an absolute avalanche. Who took the other side of that massive bet? We're going to lock down that exact answer in just a few minutes. But first, you have to see the sheer scale of the wreckage.
Talk about a split reality. Over in New York, SK hynix launches surges almost 13%, absolute blockbuster. Fast forward to Monday in Seoul. The exact same company watches its domestic shares bleed out over 15%. The broader index went into a terrifying nosedive, breaking right through that psychological 7,000-point floor and violently dragging heavyweights like Samsung down with it. Here's how fast the floor gave out. 9 a.m., the bell rings, and the market immediately crashes through support levels. By 10:34, the selling is so vicious it trips a sidecar. Basically an emergency brake meant to stop automated algorithms from dumping shares, but it completely fails. The bleeding doesn't stop until 1:28 p.m. when authorities yank the absolute final emergency lever, the seventh circuit breaker of the entire year. And guess what? Even that couldn't stop the rout.
So you have to ask yourself, who actually pulled the rug while the public was cheering the US debut? The real answer is hidden inside some wildly contradictory shipping data that will crack open shortly. But to understand that data, we first need to expose the mechanical trap that lit the trading floor on fire.
See, this crash wasn't an accident. It was a highly calculated, ruthless strategy executed by institutional giants. Think of it as a sell-the-news arbitrage play on absolute steroids. The second that highly anticipated New York listing went live, institutional profit-taking transformed into an unstoppable avalanche back in Asia.
The institutional playbook was practically synchronized. Just before the listing, major players, we're talking institutions like UBS, effectively outlined this maneuver. Go long on the shiny new US shares, aggressively short the domestic shares in Seoul, and watch the dominoes fall. The big money locked in their gains from the listing hype, and their coordinated exit ripped the floor right out from under the local market. And once that floor vanished, the machines took over. 142 billion won. That is the brutal reality of forced liquidations hitting the market in a single day. When retail traders use borrowed money and the underlying stock tanks, brokers automatically liquidate their assets to cover the hole. We saw margin calls explode from 29 billion to a staggering 142 billion won, creating this vicious death spiral of institutional short selling colliding head-on with algorithmic forced dumping.
But every sell order needs a buyer. So while the seasoned pros were trampling each other to get to the exits, who was desperately trying to buy the dip? I'm going to reveal the specific group behind this historic counterattack in just a second. But before we unmask them, we have to look at the global macro shadows that were pouring gasoline all over this local panic. Because it wasn't just Seoul hitting the panic button. The global market suddenly caught a massive chill. The Philly Semiconductor Index slid over 3%, flashing a synchronized warning sign for global memory chip makers. Add in a sudden spike in US-Iran military tensions, and international crude oil surging past $79 a barrel, and you've got a recipe for fear. That geopolitical anxiety completely warped the market's risk appetite, turning a localized tech sell-off into a massive global run for cover. And that fear created this wild split-screen reality. The foundational semiconductor megacaps, the actual companies building the hardware for this AI revolution we can't stop talking about, were being relentlessly dumped. So where did all that capital go? Right into traditional tech monopolies, like Apple. Their shares kept marching toward all-time highs, while money rapidly evacuated the volatile memory chip sector for perceived safety.
Which brings us right back to our mystery buyers. While foreign investors and domestic institutions were dumping nearly 4 trillion won, South Korean retail investors boldly stood their ground alone. They absorbed the absolute worst of the panic, stepping up with net purchases of 3.88 trillion won. Talk about trying to catch a falling knife. That is the massive $2.6 billion bet we were talking about earlier. Everyday individuals single-handedly absorbing the institutional shockwave.
And that introduces what we call the export paradox. Why on earth would a massive army of everyday traders willingly act as the backstop for fleeing institutional giants? What exactly did they know that the highly sophisticated algorithms completely missed? To find out, we have to stop looking at trading screens and start looking at physical shipping crates.
Because while the stock charts were screaming that the memory chip boom was dead, the physical export data was painting a ridiculously bullish picture. In just the first 10 days of July, total South Korean exports rocketed up nearly 54%, and semiconductor shipments, they surged an unbelievable 193% to $11.2 billion. The institutions were dumping based on fading financial catalysts and macro anxiety, but the actual physical business of moving silicon around the planet had literally never been stronger.
Analyst Kim So-kwon over at Murray Asset Securities really nailed this paradox. He pointed out that despite all this screaming and panic on the trading floor, there's actually very limited evidence that the stock plunge points to any real contraction in semiconductor demand. The emotional roller coaster of Black Monday was entirely driven by arbitrage mechanics, margin calls, and macro fears. But beneath all that financial noise, the hard physical export data was absolutely rock solid.
So we are left standing at this incredible crossroads. You've got institutional giants triggering a historic collapse based on short-term financial maneuvering, and a retail army betting $2.6 billion on the surging physical reality of global silicon demand. It all comes down to one massive question. Who's actually right? The bleeding ticker tape on Wall Street and in Seoul, or the fully loaded shipping crates leaving the ports? Whether this crash gets remembered as the top of the bubble or the greatest buying opportunity of the decade depends entirely on that answer.